Hi, I'm TJ Kistner, Chief Investment Officer at Retirement Plan Advisors. Today I'll review market performance for the second quarter of 2026 and share our perspective on the investment environment as we enter the second half of the year. The second quarter saw a major turnaround for U.S. stocks, despite a backdrop of geopolitical uncertainty and ongoing questions about inflation and interest rates. Markets focused on earnings growth, continued investment in artificial intelligence infrastructure, and the resilience of the U.S. economy. U.S. equities delivered exceptional returns during the quarter. The S&P 500 gained approximately 15%, which was its strongest quarterly advance since 2020. While the Nasdaq rose more than 20%, driven largely by semiconductor and AI-related companies. Small cap stocks also participated in the rally, with the Russell 2000 posting gains of more than 20%, reflecting a broader expansion of market leadership beyond the largest technology companies. International equities performed well too, particularly in emerging markets, which benefited from the global AI investment cycle. Fixed income markets also did well in the quarter, as the U.S. aggregate index gained 0.7% and high-yield bonds were up 2.5%, despite volatility in interest rates. Prior to the Iran conflict, the 10-year Treasury yield sat at multi-year lows, trading below 4% in February. But yields surged throughout the second quarter, peaking at 4.68% in late May, as the market's expectations on what the Federal Reserve would do this year shifted from cutting rates in 2026 to raising rates later in the year. That said, the peak in oil prices on May 19th coincided with the peak in interest rates, and the 10-year dropped around 20 basis points to close out the quarter at 4.46%. One of the most notable developments during the quarter was the broadening of market participation, as the S&P 500, excluding the Magnificent Seven stocks, is outperforming the headline index year to date. While AI-related companies continue to lead, performance was no longer concentrated solely in the largest mega-cap technology names. We think this is a healthy development and one that we've been anticipating as stronger earnings growth begins to emerge across a wider range of sectors and market capitalizations. As we look ahead, our outlook remains constructive. Economic growth continues, corporate earnings remain strong, and businesses are still investing heavily in productivity-enhancing technologies. At the same time, valuations in certain areas of the market have become more demanding, and geopolitical risks remain elevated. As always, we believe diversification and a disciplined investment process are the best tools for navigating an uncertain environment. Thank you for listening. We appreciate the trust you place in us and look forward to keeping you informed throughout the year. And remember, the future is better than you think.